Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs report data and what the Fed is looking at right now to determine what they do with rates. I want to thank our sponsor, Rocket Clothes, for making this episode possible. Logan, welcome back to the podcast.
USA! 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 Today was good. I just want to say before we go into this discussion, to all the Russians, Chinese, Iranians, disinformation campaigns, much love for you guys. We've been doing this for like over 10 years. To the anti-central bank movement, who've been clouding themselves for well over many decades. For the labor market to have held up since June of 2020, with all the shocks that we've had, and we have our own labor triggers. We believe in models, right? We believe in economic models and tracking stuff and progression models and how to talk about economics. We're about to enter another phase of the cycle that has a lot of volatility, maybe an exogenous shock. But until now, the model has all kept up and the US has outperformed for a reason, right? And today's data actually, if you took away all the tariff headlines away, I would be sitting here and go, well, it looks right. I mean, the forecast was 133 to 151,000 jobs per month. We're at 147 post revisions. Put everything in. It looks right. Manufacturing jobs were lost. The residential construction workers on a month-to-month basis was negative. So there are things we need to highlight. But we held up. We did it. As a country, we did it. So when we all pass away to the afterlife, I just want to remember the American Bears who post 2020 were never bullish, yapped their mouths off all this time. And we're going to enter another phase, but you don't get to talk about economics anymore. You will be buried in the ground with the Russians and the Chinese and Iranians disinformation campaign because we did it as a country out there. You don't get to be a part of this anymore. Done, finished, one trick pony, inverted yield curve, finished, done, go away.
You've drawn your line in the sand. I understand. Okay, so let's talk about this jobs report. So first of all, do you feel like you say we're entering this other cycle? So this jobs report is really pre anything that we can see from the trade war or not? Tell me where we are.
So when you have a shock event, you're going to have to adapt models to what the shock is. And one of the things that, so our labor triggers have always been residential construction workers and jobless claims. They have to go up. Jobless claims have to head up toward 323,000 forward moving. Residential construction workers typically lose their jobs first. We always keep an eye on manufacturing, but we had a manufacturing recession in 2015-16. It didn't create a US recession. We're a consumption-based economy. So if you look at GDP, you know, what the Federal Reserve tracks is the real consumption data, and it was positive again. So we're going to push forward that. Now we have, again, a variable that can impact jobs and the price of goods and inflation and shortage. So it's a high velocity event. Okay, so assuming Godzilla tariffs keep on going on, assuming we'll have shortages and everything, we have to adapt to that. But until then, at least the first 4 months, everything looked kind of right. This is why we like to write about the jobs reports and show what we think was going to happen this year. But now we're entering another phase, and we'll take it from there. Because listen, in 3 days, if somebody says, "Oh, we're taking all the tariffs off, we're going to negotiate for a month or whatever," then it changes, and you have to have the ability to adapt to any kind of high velocity event. They rarely happen, but we've had a few of them. Right? We had COVID. We had the Federal Reserve go into a complete rate shock into the economy in 2022. And now we have another one. So we do it accordingly so we could document this and move this forward to see how the economy reacts to something of this nature. But for the first 4 months, consumption was held up. Labor data held up. It was good to see. Now we're going to move it to another stage. And I believe the Federal Reserve is going to use one of the things they've talked about during COVID, that they kind of get moved away from old traditional economic cycle data and used other methods to make sure that if they're labor over inflation people, that the labor market was holding up during this whole time, not breaking.
Okay, so I want to get into that, but first I want to talk about the residential construction workers because that is something that you've flagged that will clearly be an indication if we're going into a recession, if the economy is changing. So, what did this jobs report say about construction
A
workers?
very, very, very tiny smidge decline.
Okay.
So the specialty trade workers are already falling. The velocity of that data line, I don't want to get too geeky, is a little bit more efficient. We always think about the apartment workers and the units completed are being done. So if there's no permits growing there, that labor is gone. You could say, well, the LA fires and the Florida hurricanes will provide some cushion for labor during that period of time. But for now, that was a month-to-month decline. Okay, so this is something we keep an eye on. Manufacturing jobs were lost. So those two things typically move with economic cycles. So we're just keeping an eye on that. It isn't anything big, but again, it's part of the model, and we progress the model going out and forward because we don't believe in setting date targets. We believe in progression models. Economic never sleeps. Variables change. You have to move with them, either positive or negative, but we flow with that. So that's the thing that we're going to keep an eye on, especially over the next 6 to 12 months. Again, 2025, the wild card was the builders, right? If mortgage rates were above 7.25 and staying there at that levels, we would have probably a little bit more aggressive discussion about that. But for now, just a smidge, both manufacturing jobs lost, residential, we keep a focus on that going out.
It's so confusing because we have these really bad headlines. We have consumer confidence down. We have all sorts of things happening. And then we get this jobs report. But from your
Well,
perspective,
the jobs report isn't surprising because the early indicators weren't breaking yet. So it depends on what you believe the jobs data should show. So for us, it's 133 to 151,000 per month looks normal. It's all the negative revisions. It looks normal. Labor market's slowing down, but it's not breaking. We're not creating a massive amount of jobs. We're going to get revisions to this report. Softening and breaking are two different things. This is why we've always tried to highlight this. But the consumption data held up for the GDP. If you take the trade data, import, export out of it, the economy was moving fine. We're entering a different stage that could affect the consumption data. But for the first 4 months, it looks about right. I mean, and one thing is that the 10-year yield fell, and new home sales, for some people, outperform maybe existing home sales are holding up. These things are holding up for right now, but we got to look forward to what it is. But it's not shocking to us because the early labor triggers did not break yet.
okay, let's go into what you think this this Fed tool that they've used before that they're going to pull out now. What is that?
Okay, so we first talk about why do we have the theory of labor over inflation? Well, the Federal Reserve in 2022, Jerome Powell said, we like the Fed funds rate to match core PCE 3, 6, 12 months. This means the Fed funds rate would be at 3% today. That's what we all thought that meant. But eggnog, Christmas party, that was it. Whole thing planned. Everything changed. They went full guns of Navarone. They were going to be super restrictive. So that changed everything for the cycle. But if the labor market, they keep on saying it, labor market, labor supply, labor market, labor. If the labor market breaks, well, we track jobless claims. They said, okay, jobless claims. Jobless claims had a spike up, but if you read the report, it's basically two states warehouse. So the bond market didn't take that report seriously. But now we're going to a phase to where I think a lot of people forgot this. The Federal Reserve literally told people at speaking events and everything, the way we used to track economic cycles, the COVID has messed up a lot of things that we went to another avenue. We called businesses and just basically said, hey, are you firing or hiring? And during this whole period of time, they kept on saying, well, businesses are still hiring. Now we've entered another phase of the economic cycle where they'll say, well, we're not doing a lot of hirings, but we're not laying off people. See, that was the whole labor over inflation theory that they'll admit that eventually. So it's like, well, we're not actually doing a lot of hirings, but we haven't laid off people yet. Yeah, you're waiting for the labor market to break, right? So that's the whole thing. So I'm glad they finally came out in public and said that, because I think some people were shocked. Well, there's not a lot of hirings, but there's not a lot of firings. Yeah, the firing variable is different for them. But I anticipate them, because this is such a chaotic event, and trying to get real time data out there. You're going to have to go into companies and just basically, hey, what's going on? What's going on? So Fed presidents' speeches become a lot more important now, because that was the first clue that we got when they were saying we're doing a lot of telephone calls, because that's basically, we think that's a more efficient way. Whether you and I agree with that premise or not, that's what they're doing in the past. So with this type of trade war event, because we don't know the scale, we don't know the deals, whatever happens, they will be doing more telephone calls. So maybe not waiting until a Jobs Friday report to get something like that. But jobless claims and telephone calls, to me, looks like the more efficient way for them. Because if they start hearing, hey, we're laying this person on, laying this, laying this, then the labor market breaking for them, that's when they fold in this regard. I'm still not in the camp that they'll like hike into a tariff. Remember these one-offs. The Federal Reserve is already at what they deem to be modestly restrictive policy right now. So in this context, hiking is probably not an issue for them unless they go into a recession. Oh boy, the shadow Fed would really kick up right about there. But in this case, speeches can be a little bit more important now, because we don't have quite the data yet, but the jobless claims would be the most efficient way. They've used that before. I expect them to use that a little bit more. I think a lot of people forgot that they brought that up in the past, but now it becomes a little bit more important for them to use that way of tracking labor data a little bit more lively than waiting for jobs reports every Friday.
It reminds me of the Beige Book, right? Isn't that the premise there, where you call up local businesses and try to get a feel for, things all over the country and what's going on?
Yeah, I mean, we have to remember there's Fed presidents in every region, so other regions might be impacted a little bit more than others, and then they all talk about it. So it gets into a very, very unique stage after now, because it's really they're all telling us, hey, listen, it's going to be the summer, so it's May, so we're not that far away from that. So I think on the cycle side, and just for the reason we talk about this is because for mortgage rates to really go, I'm not in the growth rate of inflation falling, as we could all see. If there was no tariffs, the Federal Reserve would have been doing the same thing. Oh, we're very close to neutral. We want to maybe cut rates a little bit slowly. They weren't going to be aggressively cutting rates. A lot of people are saying, oh, if there was no tariffs, the Federal Reserve did not signal anything like that at all. It was always they're going to hold policy as restrictive as possible until the labor market breaks, and then they could be a little bit more dovish. But for now, this is a little bit more interesting for them, because the regional presidents might have a lot different takes. The 10-year yield actually rose because the manufacturing data actually beat estimates. So you can see the bond market is pricing a lot of weakness that, if things aren't falling apart, yields should rise. For me personally, the 10-year yield should be at 435 if we don't have any Godzilla tariffs, and then we work off the data like that. So, it gets interesting, Sarah. This is like the first official, authentic, if we're going to go through with this Godzilla tariffs on what we do with the economy. And again, my premise has always been saying I don't even believe in this concept, because near 50% of the population in America are workers, right? We have 162 million people working. We have over 340 million people population-wise, but we have 100% net consumers, right? And of course, babies don't consume. They don't go buy something on Instagram, but everyone consumes goods and services. So what has been the death knell of every politician? Inflation, right? Everyone thinks they can get away with it, but then inflation comes and shortages, and oh my God, people get totally pissed off and mad about that. But so we're entering a stage to where that is a very big possibility. We see ships not moving. Oh, it's kind of like COVID, stuff not working right. And, but again, all of this can change like that. So if you have that capacity, then you have to adapt to it. If it's something like war, where price controls, like we always had inflation during wars because of price controls and production and things weren't working properly. So, but this is a trade war that now we're talking about 200 deals. You know what? I don't think there's like 195 countries
That's
out
right.
there.
There's
I
only
don't know where they get the
195
200 number
countries.
from.
Now, you could have multiple deals with countries, but yes, that was already
until we see them, until we actually see them sign, we have to just move forward with it and take it. And again, whenever you have a high velocity event, every day, every week, you got to find those clues, right? Mother Economics, Sarah, I know you don't like me saying this, but Mother Economics, she is a serial killer.
She is not.
She wants to get caught. All serial killers want to get caught. She will leave you crumbs. Okay, so it's our job to always be the detective, not the troll, right? And that's how it's worked always since the Peloponnesian War, Sarah Wheeler, because if economics is done right, it should be boring, not this fun, hot, sexy thing. But we're going to look for the clues, the crumbs, and take it from there.
We just got like 5 Loganisms in like a 1
all
minute
at once.
period.
I am happy today. I was just like, I saw that report and just like was, of course, we were just talking trash to all the bearish Americans and the Russians and the Chinese and the Iranians out there. So just my love for you all.
I love it. Oh, it's good to hear all those Loganisms come in like that. Just warms my heart. I know if people have bingo cards out there, they're like, man, I just got 5 or 6. So tell me what you're looking for on the tracker this weekend, right? We're recording this on Friday. We go live on Monday.
Okay, so with the tracker, again, whenever we have a holiday around a weekend time, like Easter holiday, it always messes up the data. So we're anticipating kind of a rebound in sales, a rebound in new listings, right? Remember, 70 to 80% of sellers are buyers, and new listings data took a big dive last week, and that was, Easter holiday related. Sales dipped up. Now, part of that, I believe, is mortgage rates have gone up, but sales should rebound, and new listings data should rebound. Active inventory should grow. So if we keep the same theme going, inventory growth positive, new listings data is positive. We're getting close to that 80,000, 80 to 110,000 from 2013 to 19. That was like the norm. It was really 80 to 100,000, but we did have some prints at 110,000. New listings, again, during the housing bubble crash years, this thing was running at 250 to 400,000 per week, right? And again, the grifters of society do not have this data line. This is why their price crash calls are wrong. These are not serious people. But in any case, we should get 80,000 plus this year. Purchase application data has been positive. Like, I think I might have counted it wrong. It might be 14 consecutive weeks in a row, year over year, not 13. But in this context, if you have more people who are sellers that are buyers, the new listings data should grow back to normal, right? We should get into that. Now we're as a total aggregate, we're still lower than what we were pre-COVID, but it is good to see, because the last 2 years, remember, it's not shocking that 2023 and 2024 were record low levels of sales. There were also record low levels of new listings in the history, right? So we have a lot more people, we have a lot more households. So we want to see new listings data get back. We want to see active inventory grow out there. All this is positive. Case-Shiller index last week came a little bit hotter than my price forecast, but I think things should cool down. So it looks good. Like, this is good. This is the housing market that I wanted to see really in 2023 to get balanced. We didn't get it then, but 2024 was looking promising. Remember, housing is going to be here for decades and decades. Millions of people are going to buy homes every year. But the fact that with all the headline, all the drama, elevated rates, purchase application data has been positive year over year since like the start of the year. Nothing spectacular, but positive. Right? We're getting new listings data back to normal, positive. Active inventory is growing, positive. Price growth is cooling down, positive. These were all like, the inventory was such a negative story in late 2020 and all the way to early 2022. Not a healthy housing market, but this is what a healthier housing market looks like out there. This is the whole concept of team higher rates in February of 2021. Like we need to cool this down, or else things got out of control. But imagine if home prices just rose 4.6%. That was the whole model. We created a whole model for years 2020 to 2024 because this was the period of time I've been waiting for. So 4.6% nominal real home prices isn't that big. Would have been a much different marketplace. But when you break to all-time lows in inventory with demand at pre-cycles highs, the supply and demand equilibrium, if you believe in the purity of economics and math, facts, and numbers and how beautiful it is, that is not a good thing. Okay, so this was like, oh no, this is not healthy. So all positive. We're hoping we see that new listings data come back, sales come back, and then we just kind of roll with it. We're getting toward the seasonal peaks of a lot of the demand data lines, and then we'll operate with a different marketplace the second half of 2025, and we'll see what happens with the economic trade wars. Last year at this time, mortgage rates had peaked, and they're starting heading lower toward the summer months. That is when the forward-looking demand got better. By the way, nobody talked about it last year either. Oh my God, this house in Florida is down 30% since 2022. Y'all just know ball players. That's the problem. None of you people care. You're all sorry. Literally. Oh, how do you live once? You live once this life and you're rolling with this crew. Jesus. In any case.
Okay, so when we look at one of the things that I've noticed when you're showing your charts on the tracker is that compared to last year and the year before, like this spring housing season really had some traction. I mean, again, little bit, but as opposed to last year where I think you had to call it in April or at the end of March that.
So the last two years, I've already called for the peak of sales. Monthly prints, right? I said, okay, that's it. I think it was February March for both the last 2 years because the forward-looking data was negative and rates went up. So it said, unless rates really fall back down, we're not going back. And they were both correct. Both those were the peaks of sales. Here it's a little bit different. Here it's like, it has been so long since I've been able to say 13 to 14 weeks of positive purchase application data, but the forward-looking data are holding up. That means there's a potential. If mortgage rates had gone towards 6%,
that's all we need.
Everybody's forecast would be wrong. If we had trended lower and 6%, and let me tell you this, everybody would have been wrong and everybody wouldn't have focused on it either. Why? Because we've always said this. There's not a lot of people experienced in tracking forward-looking data, and they focus too much on the low volumes, not to talk about the demand curve changing. So we had near 5 million total home sales 2023, 2024. We're going to have near 5 million total home sales in 2025, but there was a potential to actually break through that, right? So let's say hypothetical 4.4 million existing home sales, 700,000 plus 5.1 millions. That would be a deviation break a little bit from the last 2 years. Nothing spectacular, nothing great, but it shows you that there's demand there. Now, I could cop out and say the easy answer. Well, if we had sub 6% mortgage rate sales, go, yes, the builders have shown us this. They're at 2019 levels still. But we have to work in a realm where Fed policy, remember, 65 to 75% of where mortgage rates can go is Fed policy. They're not there yet. But it is very encouraging this year than the last few years to show that even with elevated rates, even with trade war headlines, even with all this, purchase application data for existing homes has still been positive. The builders' purchase application data, right? They had positive month to month and week to week. Now, they don't have a weekly data lines. They have a monthly data lines. But this is, again, with rates elevated, just get down toward that 6 and you have duration. Duration is the key to everything. You get down with duration, you got something. We just don't have monetary policy to facilitate that right now.
Well, and we have the volatility on the, like you said, with the trade stuff, we all know it could happen. It could change on a dime. And no one knows.
It could change. The real negative aspect for the trade war is similar to what the Silicon Valley banking crisis was. It's just a smaller version. Silicon Valley banking crisis pushed the spreads up 50, 60 basis points really from the lows. So unfortunately, that was the only reason we had 8% mortgage rates that year. Spreads have gotten worse, not as bad, maybe 20 to 25 basis points, but still, we could have been near, 6.5 easier. But today, bond yields went up as they should have, and mortgage pricing, hopefully the spreads compress a little bit when these yields rise to limit the damage. And we take it from there and we just track this stuff weekly. Boy, it's exciting. It is exciting, Wheeler, but today was like one of those days. I was just thinking back to 2020 and how every recession call, everything, especially those that said October of 2023, birth date models, this, that, none, didn't work. None of it worked. Stop pretending you're anyone, an analyst, an economist, or anybody. It did not work. So now we go into the next stage. We got to adapt to it, right? We cannot hold any biases on what we want to see happens. We go with the data, but the honey badger labor market, the United States of America. Oh, God, it felt good. It felt good since 2020.
I forgot about that. That was a good one. The honey badger labor market. That's what's just been the engine that has been driving stuff. So, yeah. Logan, so thankful to have you on today. Thanks for. I know you had like 4 interviews before this with other, with I don't know, Bloomberg, CNBC, whatever. So glad you're here with us, guiding us through it, and we will talk again soon.
Have a good Monday, everyone.